This conference will now be recorded.
Hi everyone, it's Patrick Reed from the Adamas Principle, and thank you for joining us. We've got some great ideas, and we've been talking offline actually quite a lot today, but it's something happened, and I just want to kind of be gave me the idea of having this risk off special, and there are two things that happened that I feel that are really important above and beyond um, anything else really. And two big events for me were the FOMC being being dovish, but the dollar fade was well and truly on, some cheap dollar buying there, and then and for me, I've got my own reasons. I quite like looking at rates, and that was unchanged before and after. So I could understand that move very. It was just pretty basic for me. It was glaring rather than basic. But it could have been a whole few other reasons. But what happened is there was a perfect fade on the dollar on Wednesday. Friday was the big one, and a real miss on German PMIs at 44. I think, and B, you were talking about this with me offline, in that the market now is possibly joining the dots with the dovish Fed and the link with China and a global slowdown, and the fact that yields globally are very low, and the fact that the bond market moves. Now, everyone's talking about that, and everyone's, if you look on zero hedge, there's a lot of, we're getting into an inversion, a recession. Both Beat and I think we spoke about this, it doesn't matter, right? You sometimes in trading, you've got to realize what's actually happened and take it at face value as a market participant, right? So what actually happened? Okay, risk got on Friday because of EM. Okay, yen pairs got much lower. The bond market moved. 10-year got bought. 30-year got bought. That hammered the yields, which obviously then this inversion. But it doesn't matter. Whether it's inverted or not, it doesn't matter. But bonds got heavily bought. This is a representation of doubt in long-term growth, right? That's it. There's nothing more. So I just want to get that out. Anyway, never mind me bleating on. I haven't even introduced the rock star that is Beat. Hello.
Hi, Patrick. Good evening. How are you?
Hey, I'm very well. And good to have you back, mate. Good to have you back. How's your week been?
Yeah, to be honest, I had a fantastic week in the Middle East. I needed a break from all. It's not from you, but just from just from.
Come on, you
To be honest,
I'm okay. I'm okay. I'm heartbroken.
yeah, no, it's been a long year already, and I just figured I'm not going to miss much in a week. And I think I came back Tuesday, and Wednesday started rock and roll. So perfect timing.
Yeah, yeah. Well, absolutely, absolutely. I guess you know, as I sort of mentioned before, it's about risk off, and something really matters. Something, the stars are starting to align for risk bears, right? And we have sort of been here before, but not quite the same with the bonds, and rates as well. And I just feel, it could be the one now. Could be the one where we're really going to sell off. Yen's falling in line. Sorry, EM proper risk is falling in line with G10 and yen pairs. So that could be something. The bond market moved substantially, so that's another thing. You had the dovish Fed, of course. I wonder why. You had a dodgy PMI in Germany. You've got the market thinking about the China relationship. You've got global bond yields much lower across the board. The only thing is equities, and that may be propped up by buybacks, could end in April. The desk talk I'm hearing is going to be a lot of restrictions in April. if there is, it's going to be carnage for risk. I can tell you that for nothing. It's going to make what happened on Friday look like a walk in the park. So yeah, Beat, what are your thoughts? I mean, I just want to take a look on the charts first. One sec. Get my thing up. Interesting. Let's just keep it really simple. Looking at the dollar index, we are just below the mid-Bollinger Band. Obviously, we tanked. We bounced off that lower Bollinger Band there. We could, if we hold this, we could potentially see some dollar selling into Asia through to London. But what are your thoughts on the broad dollar? I will come to risk in a minute. I know it's a risk-off special, but any thoughts on the broad dollar there, Pete?
To be honest, mixed. To be honest, I mean, like I sort of blogging midweek that my game plan was to fight 114.45 in euro dollar. It was the feeling that if the market gets a dovish Fed, that's how high we could go to that big FIBO area, 14.45. And similar to you, for me, given that the market has priced out any hike and that the market actually pricing cuts in early 2020, there's just no way that you sell dollars after the initial knee-jerk reaction. I mean, I did expect the knee-jerk reaction. I was waiting for it to actually fade it. I'm square euro dollar now because I think euro dollar is going to become very complicated. I think we have to now start to look at different dollars with different kind of view. Dollar yen, I think we go back to what we discussed in December, that maybe now that things start to unravel, dollar yen is actually the truly only dollar you can just be short. The other dollar is going to be complicated. Euro dollar is going to get complicated despite the weak European data, but we have massive lower yields in the dollar. So at some point, euro dollar will not know anymore should it go down or should it go up. So I personally feel it's going to get complicated. I think the dollar index is going to get complicated because you're going to have probably a dollar yen that wants to go down. We're going to have the dollar bid against EM. We're going to have the dollar bid against Aussie, Canada, the usual suspects. So I think we are at the junction again where you stop focusing on the dollar as a dollar. You now have to no other choice than, or let's say, you have to make a choice whether you're going to focus on the dollar and you start selling dollars across the board because of US yields. I think you're going to get hurt because I think you will sell some of the dollars that you are not supposed to sell. And even though you want me to talk about the dollar, I think right now we're at a junction where you cannot talk about the dollar without actually talking about risk. And from what you already said in your intro, I think I actually had to laugh when you were blogging about Grundlach's comments on the Fed, because we have used the same terminology in one of our Sunday nights. When we talked about that, what we've seen from the Fed is unprecedented.
Yes,
it's unprecedented in terms of speed, from going everything is honky dory to not everything is quite well. That's just in the space of 3 months. That's unseen. What's further unseen, and which I was blogging about during the week, is you have a Federal Reserve that hits the brakes while the data is actually okay. I'm not saying it's great, it's okay. You have a ECB and you have like horrific. I mean, I had to look twice about this PMI. I just couldn't believe that it's at 44. And I think this, if it would be Italy or France or Spain or whatever, people would go, yeah, whatever. We're talking about the growth engine of Europe. We talk about the economy that has actually survived 2008 with almost like without a scratch. And now here we are, 2019, ECB not having even started to normalize policy other than stopping QE. And you have the growth engine that bailed out Europe in 08 and in 2013, 14, that is just hitting rock bottom, right? And I think, like you said earlier, I think now people start to slowly understand, wait a minute, the Fed has made an unprecedented U-turn. The ECB now suddenly start to make a lot of sense. They obviously, let's say, they were probably dovish, but if you look at the German data, you wonder whether actually they were dovish enough. So reality is, from talking about the Fed being behind the curve, we could as well start to argue, well, wait a minute, if the Fed goes dovish while data is okay, what should the ECB actually do? The ECB, in theory, should be actually already prepare themselves to start to throw the kitchen sink at it again, right? Because reality is, rate hike in early 2020, forget it. Well, I mean, it's not going to happen. TLTRO, boring. I mean, you're not gonna, convince anyone that you start to buy, Europe for a TLTRO. Even I think a friend of mine blogged something about, the famous Draghi sentence and the challenge for his successor about repeating the whatever it takes. I think the market will not even blink on whatever it takes, because what, right? So I think the ECB is running a really big problem. There is the back to the wall. If things continue as they do, I think there's a real problem that the market could actually enter in a sort of panic mode, because knowing that the ECB is running out of bullets. Yeah, they can restart QE. Okay, bothered. I don't think it's going to do the trick. So the one thing to understand, and it wouldn't be the first time this happened, I actually think the Fed actually might have to come to the rescue to the world this time, bailing out the ECB. But at some point, if things really start to get worse, it's probably the Fed that suddenly has to start cutting rates to actually save the developed world, Europe, the US, and others. So maybe that's a bit early just now in March, but this is just where I think it's going to go, because the ECB really has nothing left, in my opinion. To me, there's just, most people that are watching us know how bearish I am. I was a little bit on the back foot in recent weeks. There's nothing really worked, but one thing I was blogging about, or we talked about, emerging markets made me hang in with my views. Emerging markets have traded poorly through that whatever naive carry rally that we have seen. Yeah. If you look at Turkish yen, if you look at Rand yen, even when the whole G10 yen complex was rallying, Aussie yen, Canada yen, Euro yen, whatever, those were actually selling off. So if you have a true carry, if you have a true risk on, the first carry people buy is the true high yield carry. So you want to buy Turkey at 24%, you want to buy Rand at 6, 7, 8% yield. You're not gonna buy Euro yen at first that has hardly any carry, right? So that sort of conundrum, I just realized, is inconsistency. That's why I did hang on to my risk view, my risk off view, because I just tell the emerging markets telling me there's no risk on at all. It's more like the market is running low convictions. So if the market is going up, the market buys and thinks it's bullish, and vice versa. That's, I think, what we've seen in the last 8 weeks. Last week, to me, was the actual key where the penny dropped with many people. And that's why next week, next to that, it's a huge week for the UK, is going to be a key week for where we're going to go in the next many weeks. Where if the penny dropped last week, we actually have IFTERM and IFO as well next week, which is going to be quite interesting. If you get some sort of a repeat or sniff similar to the PMI, then I'm not saying it's lights out. Lights out is going to come later in 2019, but I think there's just no other way to look at this than what we see. And what we see is the global slowdown is real, and any whatever trade deal between the US and China is not going to change anything of that at all. Definitely not in the short term. And the other thing we see, because China is kind of, don't want to use the word cheating, but they don't tell us what's really going on in their economy, right? It's a closed economy. They can hide stuff. We don't even know what the true debt is of that country. But what we do see is the knock-on effects to those economies that deal with China quite heavily. Germany, Australia, whatever, right? So to me, the truth is that the China economy, in my opinion, is in a far worse state than we were made to believe. That is just my conclusion when I look at global data. So that means, you know, it's very hard to see when that is sort of done. I'm not saying China's going to have a hard landing. It might, who knows? But next week is going to be key, and I just continue to be, I'm short risk. I cannot continue to be short risk. I squared up my short euro dollar. Can it go lower? Yes. Am I bothered? No, because I don't think it's going to be an easy trade. The easy trade for me is short Canada yen, short euro yen, you know, short Aussie yen, dollar yen. Every rally you sell dollar yen. I think dollar yen will go to 100 this year. You know, done a little bit whatever it's been doing up there, but it's coming. You know, and I think last week and now with the lower. That's why I say now with dollar yields, what they've done, it's obviously a lot easier to be short dollar yen. So for those people that are bearish dollar, you know, why do complicated things in euro? Because do you want to buy euro with the sort of European data you have? No, you don't. You want to, you know, do you want to sell a lot of euro down here when 10-year just is starting to knock at 240 after we peaked at 325? No, maybe not. So that's why euro dollar for me at the extremes. Oh, I'd be right there, like last week. I sell it 114 handle. Do I sell it 112 handle? No, not at all. No interest. That's kind of where I am, and I think my confidence is back in regards to what I've been believing all of 2019. That the real deal of 2019 is risk off, and if you're unlucky, it's going to get a lot worse than what we've seen 10 years ago. Maybe, you know, let's not hope so, but there is a risk of that.
Well, that's pretty good. That's I mean, I guess I'd like to see a little bit more conviction in the bond market, and it would be nice to see the S&P not be so divergent from global yields.
Yeah.
I'd like them to follow suit a bit more, because they're still unnervingly, unnaturally high. So with this, I mean, we all know it's buybacks, right? So that's the only thing I'd like to see come off. Then I'm going to be throwing in the kitchen sink myself.
Yeah. To be honest, what I could see happening when you mention stocks is there might be a little bit of delay for stocks, because obviously some people just look at the yield versus equity correlation and sort of think a dovish Fed and the lower US yields is bullish for stocks. So we have to probably work ourselves through that. You know, those people that think it's bullish start to realize that stocks don't bounce. Once stocks don't bounce, that probably needs, I don't know, maybe another week or two. So I think where I do agree with you, I don't think we're at a stage where you just hit every silly bit in risk. I don't do it, right? And I'm very bearish, but I'm still cautious. I even cut some euro yen shorts into this dip just to go like, you know what, similar as what you say, it's not guaranteed yet. We had a tough first 3 months of the year, so it's maybe not wrong to take a little bit, a few chips off the table. You know, if it continues, okay, we short. At least when you short and it continues and it accelerates, you're already short some, so it's easier to sell low ones. If it bounces, you have a little bit less risk. You can sell into the bounces. So it's definitely unclear, and we're not at a point yet where you just hit every silly bit. I totally agree. You know, we had a big move if this is just a preparation. So I think this is the preparation. This is probably, you know, late 2007 rather than mid 2008.
Maybe it's the Bear Stearns moment before Lehman.
Yeah. Well, no, it's not there yet, right? It's
not quite, yeah.
You know, in 07, if you remember, we had two events in 07. February 07, we had a drop. We had quite an aggressive drop in yen crosses, when these two credit funds from Bear Stearns went under. That was February 07.
Yeah.
So we had a quick sort of few weeks of massive, strong risk off. And then suddenly everything gone quiet, everything rallied, everyone saw like it's over. And then came October when people start to realize, oh shit, it's not over, right? And you know, the rest is history. And we are somewhere in that very difficult conundrum kind of, where are we? Everyone senses that actually could happen. No one wants to pull the trigger. The equity guy, the other thing I keep warning people about, you made a very good point about the buybacks, and the last 2 years has really, the buybacks have spoofed the market a little bit in terms of, you know, pretending the equity market is stronger than it actually is. But the other thing we shouldn't forget, and probably around 50% of people that are in the market now have not been around prior to 2008, right? Maybe it's 45%, maybe 42, but just, you know, give or take, half the market has not been around before 2008. So let's see when these people wake up to the fact that if something dips and dips and dips, you know, we have half the market has made a lot of money, or good money, with buying the dip. So we have to hurt these people first. I mean, I'm not meaning in a bad way, but
yes, you are.
So there is a moment when those people had never seen the stock market just going down, down, and down again, you actually know, wow, what's happening, right? So, you know, we still have a little bit of people that have the hope that the trade agreements will make a big difference in equities. So they're still trying to hang on to it. And don't forget, given where the price is, if you look long equities, you haven't really been forced. You had one big test, you know, like 2 months ago, whatever, when the Dow quickly went to below 2,300 or 23,000 actually. And since then, you know, S&P is 2,800. It's back at least below this big 2820, but it's 2,800. So if you're long, everyone talks bearish, you go like, okay, what are you talking about? Right? So, and I can't argue against it, because yes, it's 2,800. Yes, it has made new highs. So there is me talking bearish like hell, while the stock market is looking okay. But the balance of evidence of the last many weeks is piece for piece for piece negative news that has been ignored by the equity market for the last 2 months, maybe 3. And it's not going to last, you know. And the dovish Fed is not bullish this time.
Yes.
That made U-turn in 3 months is actually, you know what? I tell you one thing: the same Fed 15 years ago, which would have done the same as they've done now in last week, the market would have collapsed, because there you have, you know, discretional people who go like, oh shit, the Fed is worried, yours, right? The only reason the Fed get away with it now is because everything is kind of machine driven, algo driven, artificial intelligence, and they don't even understand what this is all about. So maybe they get away with it. But I tell you one thing: everyone who has a brain, who has been trading for quite a while, who sees what the Fed has done, would just press all the sell buttons, because this is beyond normal what the Fed has done. This is a Fed that is worried. I don't want to use the word panic. The ECB is about to panic. The Fed doesn't have to panic because they hiked 8 times. Okay, you know, Powell sits there, easy peasy. If I need to cut, I cut. As he told us, watching data. The data turns sour, I cut. If the data doesn't turn sour, I don't cut. So he is probably pretty chilled at this point, even though he had to pull the handbrake up, because he had to make the market understand that, oh, wait a minute, you know, things are not as good as we thought they are. And that's what they basically said in the meeting, right? In December, everything was fine. In March, suddenly it wasn't. And so they got away with it without the Dow finishing down 1,000 points on panic, because I think half the market, you know, I don't want to be that arrogant to say I'm the only one who understands it. I'm not. But I think the market is misunderstanding what's going on. I really do.
Yeah.
at the end, things will happen. What has to happen will happen. And the longer it doesn't happen, the more painful it's going to be. And the faster it's going to be. So make sure you always short a little bit of risk.
Yeah, so a couple of things there, mate, is maybe I didn't say it, but I'd only throw the kitchen sink if stocks rolled off properly, because I think that's the last green bottle on the wall. And I think because we're still in, we bounced from those lows, especially S&P, and then we're still around that, below that 2820. And I just think that if everything really rolls over, like we see a proper stock rolling over, that along with the bond move on Friday, along with joining the dots with the European engine, which is Germany, with PMIs and China, that will mean that a dovish Fed and a dovish ECB is a sell for risk, as you say. And I just think that's the last thing that this needs to, the last piece of the bearish jigsaw, that it's not really playing ball. EM's playing ball for risk off. Yenpes getting hit. The bond market, which hasn't really, significant. I mean, 10-year yields have been really soft, but not the long end. And I just think that what happened, as I mentioned before about the inversion, all that really is, to me, is 10-year and 30-year bond being bought because of the worries, and that hasn't happened before for a while. So all of that together, it just needs stocks to roll off, and then I'll throw the kitchen sink at it.
To be honest, in terms of some people argue, the Fed is going to support stocks. I just quickly brought up my long-term chart in the Dow back to 2008. We did test the 23.6 FIBO on the last leg down that we had in December, so that's around the 22,000 mark. Now, let's not forget, the Dow has been at 6,000 in 2008, right? So you cannot honestly believe that the Fed is going to throw the kitchen sink at stocks at 25,500, right? Yes, if they come off brutally fast down to 22,000, 20,000, maybe some stuff is going to get done just to slow it down. The Fed, and I remember Powell saying, I watched an interview back end of last year when they asked him about equities. And he did actually say back then that he didn't use overpriced, but he used something in that way that he feels that equities are priced very highly. So the Fed, the ideal case for the Fed would have been, which hasn't happened, which actually this whole buyback screwed the Fed as well. Because what the Fed would have wanted to happen when they hiked these 8 times, these stocks to just gently grind lower. The level, the level is not a problem. If the Dow would be standing at 20,000, would America be like in disaster? No, it would not, right? Or 22,000, whatever. The only problem they now have is the whole hikes, or the part of the normalization. Stocks are nearly at the same level as before. That's the problem, right? Because the Fed would have much rather wanted the stocks to come off slowly. So you hike rates, stocks grinding lower, fine, right? Suddenly you're at 20,000, the Fed starts to cut rates, and whether then people start to be bullish and buy it, yeah, fine, whatever. But at 25,500, near the all-time high, the Fed can really not start to prop up stocks without having seen a fall first. It would just be beyond irresponsible to start to push that bubble even further, because this is a bubble. Without a shadow of a doubt, if I see a bubble, I see one right there, right? And it's just out of sync. And the whole problem of QE is, we had the same problem in the bond market. 10 years of QE has put prices to levels where we just cannot judge what the true price is. We can't, you know, and if you can't, at some point we're going to have an adjustment. The adjustment is going to happen fast because no one actually knows where it should be. And if it starts to go down, it's going to go down fast. But you know what, like you rightly say, it may not happen on Monday or Tuesday. Maybe I'm, you know, talking too bearish in terms of already calling the end of the world. Again, it's probably happened later in 2019. But, you know, I think I sent you the chart with the debt, with global debt.
Yeah.
Right?
Yeah.
And where debt is now versus it was in 2008. So reality is we haven't solved anything. We have made the problem bigger. The only thing we have done with QE and all this corporate bond buying, we have like kicked some of the debts into government hands, what used to be maybe in different hands before, but we haven't solved the problem at all. So I'm just slightly nervous, and that's just, you know, now everything we said combined with the obvious slowdown that we see in the world that happened, it surprised every central bank. And the last thing I say on this topic, that's why I'm so bearish Canada. Bank of Canada is the next rollover. You know, the market has bought a lot of Canada in the last 6 months on the back of Bank of Canada. So what I talked with you about in 2018 about always being short Aussie and Aussie yen, now I talk about always being short Canada and Canada yen. So that's my new baby for 2019, next to a few other things. But Canada is my big focus right now because Bank of Canada will have to sort of fall in line with the rest of the central banks.
So poor old Aussie yen, not very popular as a risk.
No, I mean, to be honest, I mean, I will always be, at some point, I will always be short some. So it's not that I will be short, but the problem is what I try to do is the work I do is, you know, they're easier. And let's say there's I always try to make a ranking of, they all work, right? Or when I speak to my students, it's all about, it doesn't matter at the end which yen cross you short, but there are better ones that move more, and there are those that move less. And what we're trying to do, we're trying to find the imbalance. And if you look at the last 2 months, we had several big legs higher in Canada yen. When the carry guys just came in, woof, you know, just bought this stuff like there is no tomorrow. Aussie yen, if you compare it with Aussie yen didn't have that big move. Aussie yen didn't even break that 79.70 level, right? While Canada yen broke that old, can't remember what it was, 83.80 or 84.20, whatever. You see, Aussie yen has never had these kind of, you know, waves of buying that the Canada yen had. And so I think there is more juice in Canada yen than Aussie yen. We're talking about, you know, the world is being bearish Aussie for, you know, the same as me, all 2018, 2019, everyone keeps selling Aussie every rally, which is fine, it will work. But I think there's just more juice in the Canada yen because RBA, we know it's dovish. We talked already about a rate cut by the RBA in summer. No one talks about a rate cut from Bank of Canada.
Right.
You know, Bank of Canada has blinked a little bit. It seems the market hasn't quite listened or whatever, so they're going to have to repeat themselves. So I just think there's more positioning, right? So I would think there's quite a few longs in Canada, while I don't think we find that many longs in the Aussie. So it's a positioning case. I think it's a policy case where we come out of a. Don't forget, Bank of Canada hiked rates more than once, right? So if you just compare what the Bank of Canada has done versus the RBA, tells you that more people will be long Canada than there are kind of long Aussie. So from a pain point of view, when it rolls over, there's more juice in Canada as well. So my Canada yen pet love now is not meaning that I won't sell Aussie yen. Aussie yen always belongs a little bit to the portfolio, but I just spend more time trading Canada than I do in the Aussie. And that's really it. But as I said, you can be short Euro yen, sterling yen, Aussie yen, Canada yen, dollar yen. You're going to make money at the end in all of them. I just think there are a few better ones, you know, or easy ones. On the flip side, you could argue if you've been short Aussie yen, some of the squeezes were less painful as well because people not that involved, right? But there we go. I always try to have a favorite pair, and Canada yen has been my favorite most of 2019 now. My
That's
new
fantastic.
and I can't believe I say this because I hated Canada all my life, like really badly. Canada has treated me very bad in my career, and so I'm really surprised that I find myself attracted to Canada. But there you go.
Yeah, I think we've all traded the loonie at some point, and I personally, this is a bit of an admission. I went for about a year. I always used to think it would be different next time.
Yeah.
It wasn't. They'd give me one big win, and it used to move like dollar Canada used to move back in the day, and I was doing futures, and then it would make me lose another 10 times, and then give me one tiny win, and
Yeah.
it'd all go back, just like
To be
cool.
honest, I have met fantastic traders in my career. I mean, really brilliant traders. I have back then, and we're talking more about the sort of older days. I've not seen one guy making money, even the best trader. They made it one day and they lost it like in the days to come.
Yeah,
I think nowadays Canada, let's say Canada actually these days doesn't deserve the name loonie anymore because it kind of started to move a little bit with more sense. It actually makes sense at times that the way it moves. Back then, it being called the loonie because it just started to move. Suddenly it goes like up 300 points. You go like, yeah, it's probably safe to sell. It gone up another 200. So okay, see you later, Charlie. Now at least with first we don't see the moves that we used to see. Yes, it moves a little bit more than the Aussie still now. It has its old 100, 150 points, but that used to be 300 and 400 points, right? Just when you think it's over, it just goes another 200. So now I find it easier to trade now than I did 10, 15 years ago. At least now at times it makes sense. But there you go.
good stuff, mate. Well, look, I'm going to leave the euro yen, which is my favourite risk pair at the moment, just because of PMIs in Germany. And if you just look at, just going to look at just in technical terms, in broad technical terms, this just looks like it's rolling off, really. I mean, you've got, you're just getting nice ledges up here. You've got this 127.50, which is a bit of a level there for me. And you've also got the top of the Bollinger Band. Thanks to you, Beat. You've brought me onto the Bollinger world. Thank you very much. And it's just looking like very, very toppy for me. So, maybe I'm just going to be trading a bit more euro yen than I normally do. But Canada yen is another great pair. I know it's your favourite. It's your replacement for Aussie yen. But you've got a lot of opportunities. And I think the things are all falling into place for risk bears. We just need stocks to roll over a bit. That will be nice, but let's not hope. Let's not expect that to happen because of still being propped up by buybacks. But I think that's it for today's show. That's thanks a lot, B, and we missed you, and you're back with a bang.
Yeah, I almost feel like it as well.
Fantastic. So before we go, I just want to mention your amazing commentary. It's certainly helped me out a lot, and it's you put a ton of work into it. So without further ado, Beat, would you just let us know about
Sure,
the amazing work you do?
Yeah, so what I do is I just send out my 4-hourly daily charts in the morning. So the 4-hourly charts being for the sort of day traders, the daily charts more for the macro guys. I write a little bit of research on every chart, my sort of thoughts about what we do, where we are, which way I think we're going. I write a piece, my 2 cents, where I usually try to just sum up where I think the world is and where the world is going. And sometimes, more often than not, I actually kind of see where the world is going. So whoever is interested in, receiving a 1-week free trial, just ping me directly or ping Patrick, and I will organize it and we can take it from there. Thanks very much, Patrick.
Great, that's great. Well, thanks very much for tuning in to the webinar of the Risk Off special. Watch it, watch that risk. It's your favourite, it's your best friend, and we'll be both blogging on LinkedIn with our usual bits. So yeah, here's to a great week. Thanks very much.